While the mainstream financial media spent the week fixating on ceasefire negotiations in the Strait of Hormuz and oil prices collapsing below $100 a barrel, something happened in the silver market in Shanghai that almost nobody is talking about. The Shanghai Gold Exchange's AG T+D contract has been pricing silver at a premium to Western spot that, when you factor in China's 13% VAT on physical delivery, translates to a delivered cost north of 55% above the number you are watching on your screen right now. At the same moment that COMEX registered silver inventories have declined more than 80% from their 2021 peak, with a paper-to-physical leverage ratio of 7.5 times sitting above only 124 million ounces of actually deliverable metal, China's export licensing framework, which took effect January 1, 2026, has structurally severed the flow of refined silver that once rebalanced these exact situations. 3 signals, all pointing at the same fracture, at the same time. That is not a coincidence. And if you don't understand what it means for the value of your silver stack, you need to be watching this right now. John here. Today is Monday, April 20th, 2026. This is not a routine update. What is happening in the Shanghai silver market right now represents a simultaneous, structural convergence of physical demand, export restriction, and COMEX delivery strain that is unprecedented in the modern history of this metal. Before this video is over, you are going to understand exactly why the number on your silver price app is not the real price of silver, what the Shanghai premium is actually communicating to institutional buyers right now, and why 95% of retail investors have not yet connected the dots between China's licensing framework, the registered inventory collapse at COMEX, and the 6 consecutive years of structural supply deficits that have quietly consumed more than 760 million ounces of above-ground silver stock. Here is the hidden mechanism that almost nobody is discussing. China's new export licensing system concentrates silver export authority within just 44 state-approved enterprises for 2026 and 2027. That is not a quota reduction. That is not a tariff. That is the elimination of approximately 95% of all previous export participants from the market, overnight, mirroring the exact same rare earth strategy Beijing used to create structural choke points in industries that had no short-term alternative. If you are already holding physical silver, today's data validates your position at a level that the paper market has not yet fully acknowledged. If you are on the sidelines, there is one specific factor that today changes your calculation. The SGE premium you are about to hear is not noise. It is price discovery happening in the world's largest physical silver market, running ahead of a Western price system still anchored to paper contracts. Here is exactly what we are covering today. First, today's exact price data on both silver and gold, and what the intraday behavior of both metals is technically communicating about the state of physical versus paper markets. Second, the Shanghai premium in full detail, what it is, what is driving it to these levels, and why it is categorically different from the regional premiums this market has seen before. Third, the COMEX registered inventory picture, the paper leverage ratio, and why May 2026's first notice day, now 8 business days away with 47,034 open contracts representing 235 million ounces, is the most important near-term catalyst this market faces. Fourth, China's export licensing framework, the story that mainstream financial media has almost entirely failed to contextualize for retail investors, and what the restriction of silver to 44 approved exporters means for the 60 to 70% of the world's refined silver supply that runs through Chinese processing infrastructure. Fifth, the Fed and dollar picture as of today, and why both the hawk scenario and the dove scenario produce the same constructive outcome for precious metals. Sixth, what top independent analysts and major bank research desks are now projecting for silver and gold through year-end 2026, with specific numbers that will reframe everything you think you know about where this market is going. Stay with me through all of it. The full picture is the point. As of the open this morning, April 20th, 2026, silver spot is trading at approximately $80.50 per ounce, with intraday action showing a bid of 80.30 and an ask of 80.70. The intraday high in this session has touched $82 per ounce, and silver is on track for its 4th consecutive weekly gain, now running approximately 3.6% higher week over week and nearly 30% above its March low. Gold is trading at approximately $4,867.92 per ounce, up 1.47% on the day, with intraday momentum confirmed by sustained buying into strength rather than the sell-the-rally pattern you see in momentum-driven markets. The gold-silver ratio has compressed to approximately 59 ounces of silver required to purchase 1 ounce of gold, down sharply from the mid-60s where it sat just weeks ago. That ratio compression is not sentiment. That is not retail FOMO. When the gold-silver ratio tightens while both metals are rising simultaneously, It tells you that industrial and monetary demand for silver are converging in real time, that the bid beneath this market is structural, not speculative. The dollar index is trading at or just below 98 this morning, posting its third consecutive week of declines, having fallen roughly 0.5% today on ceasefire news that is pricing in a 50-50 probability of a Federal Reserve rate cut by year-end, up from just 30% probability 48 hours ago. That is not normal price behavior across these three markets simultaneously. That is a market under acute structural stress, attempting to find its true level across multiple interconnected systems at the same time. Now, before we go deeper, you need to understand what this market was doing before today, and more importantly, what the mainstream narrative got wrong. Heading into late 2025, the dominant Wall Street talking point on silver was that the metal had run too fast, that industrial demand was priced in, that the gold-silver ratio would mean revert higher, and that any pullback towards $60 an ounce would signal exhaustion. Silver did pull back. It tested $70 on multiple occasions between March 19th and March 30th of this year, bouncing off that level 3 separate times before the current leg higher began. The mainstream read that as confirmation of fragility. What they missed, what they consistently miss, is that every fundamental factor that drove silver to its all-time nominal high of $121.67 on January 29, 2026, was still entirely in place during that pullback. The 6-year structural deficit did not disappear. The COMEX inventory drain did not reverse. China's export licensing framework did not get rolled back. The dollar did not strengthen in any durable way. The pullback added volatility. It did not change the architecture. And the interruption is over. What comes next is built on a stronger foundation than what came before. Now let's go to the signals, because this is where the convergence becomes undeniable. Start with Shanghai. The Shanghai Gold Exchange's AG T+D contract, the primary physically settled silver reference price in China, updated hourly during SGE trading sessions, is currently pricing silver at a premium to the Western XAG USD benchmark that, before VAT, runs to approximately 13 to 14% above Western spot. That is the number you see quoted on comparison sites. But here is what those sites don't explain. When a Chinese buyer actually withdraws physical silver from the SGE exchange system, when they take delivery, which is the point of the SGE, because unlike COMEX, which settles fewer than 1% of contracts physically, the SGE is designed for physical delivery. That buyer pays China's 13% value-added tax on top of the already elevated benchmark price. When you add the market premium and the VAT obligation, delivered silver in China is running at a total cost that exceeds the Western spot price by more than 55% for end buyers taking possession of physical metal. Let that number land. 55%. You do not sustain a 55% premium in the world's largest physical silver market when you have adequate supply. You sustain it when the physical market has structurally disconnected from the paper pricing mechanism. And here is what makes this categorically different from the premiums this market has seen before. In prior premium episodes, and yes, Shanghai has traded at a premium to London and New York at various points over the past decade, the differential was driven by currency controls, import quota mechanics, or short-term demand spikes from the jewelry sector. The premium would develop, attract arbitrage flows, Western silver would ship east, inventories would rebalance, and the spread would compress. That is how a functioning market is supposed to work. That mechanism has been broken. Effective January 1, 2026, China implemented a dual-license export control system that concentrates refined silver export authority within 44 state-approved enterprises. To qualify for a license under the new framework, a firm must have an annual silver production capacity of at least 80 tons and meet stringent credit and compliance thresholds that effectively lock out the hundreds of small and mid-sized exporters who historically provided the arbitrage flow that kept east-west price differentials from becoming structural. According to CNBC reporting from December 31, 2025, China's state-run Securities Times cited an unnamed industry insider who confirmed the new policy formally elevates silver from an ordinary commodity to a strategic material, placing its export controls on the same regulatory footing as rare earths. This is not speculation. This is on the record, from Beijing, which means the arbitrage mechanism that once compressed the Shanghai premium is now filtered through a government approval process that has geopolitical leverage as one of its explicit design objectives. China currently controls between 60 and 70% of the world's refined silver supply through its refining infrastructure, not necessarily because it mines the most silver, but because it built the dominant processing capacity. And that distinction matters enormously. You can find silver ore all over the world, but turning that ore into the 1,000-ounce bars that COMEX warehouses accept and that global industrial supply chains require, That process flows through Chinese infrastructure at a rate that makes Western alternatives effectively irrelevant on any short to medium-term timeline. The projected export reduction from Beijing's new licensing framework, conservatively estimated by multiple analysts at 30 to 50% of previous export volumes, translates to a potential 1,400 to 2,300 ton annual shortfall for Western markets that previously depended on Chinese refined silver. And that shortage is landing at the exact moment that industrial demand is accelerating, not contracting. The IEA projects that by 2030, the solar and EV sectors alone will consume half of global silver output. The solar photovoltaic sector currently consumes over 200 million ounces annually, and that figure is on track to more than double by the end of the decade. An electric vehicle requires approximately 100 grams of silver per battery management system. A single solar panel requires approximately 20 grams. Silver has no viable substitute in either application. Its conductivity and reflectivity characteristics at the temperatures and current densities these technologies require cannot be replicated by copper, aluminum, or any other commercially available material. That means industrial demand for silver is effectively inelastic. Factories don't stop buying silver when the price goes up. They pay the premium and keep running their production lines because the alternative is shutting down. Now layer on what is happening at COMEX because this is the second major signal, and it makes the Shanghai story even more urgent. According to the latest data from CME Group and analysis published by goldsilver.ai as of this week, COMEX registered silver, the metal actually deliverable against futures contracts, the pile the exchange can draw on, stands at a coverage ratio of 13.2%, with a paper leverage ratio of 7.5 times. That means for every physical ounce of silver available for immediate futures delivery in the COMEX system, there are 7.5 paper ounces outstanding in contracts, and registered silver has declined 2.3% in just the last 30 days, with 1.8 million ounces withdrawn from the deliverable pool in that window alone. The May 2026 COMEX contract first notice day is now 8 business days away. Right now, 47,034 contracts remain open in that May delivery month. Each standard COMEX contract represents 5,000 troy ounces. Do the arithmetic: 47,034 contracts times 5,000 ounces equals 235.2 million ounces in open interest approaching first notice day. The analysis from Real Clear Markets in March of this year documented what is already happening in the delivery pipeline. For 15 consecutive months through early 2026, physical silver has been leaving COMEX warehouses at volumes the exchange has never processed in its history. December 2025 produced 65 million ounces in physical deliveries, a single-month record. January 2026 followed with 49.4 million ounces, more than 7 times what January 2024 had generated. All of 2025 combined settled 474 million ounces of physical silver against 203 million the year before. The number more than doubled in a single calendar year without a headline event most people could identify. And as the Sprott Physical Silver Trust doubled its capital raise program to $2 billion in January 2026, enough to acquire approximately 18 million ounces of physical silver, representing roughly 16% of COMEX registered inventory in a single institutional move. The message from the largest institutional physical silver buyers in the world is unmistakable. They believe allocated physical silver is worth more than the paper claims against it, and they are committing capital to that thesis at a scale that moves markets. You do not drain COMEX registered inventory by 80% from its 2021 peak, sustain 15 consecutive months of record physical deliveries, and see the world's largest physical silver fund double its capital raise program because the market is functioning normally. This happens when the paper system is under pressure from a bid for real metal that it is structurally unable to satisfy at current prices. Now let's go to the macro layer, because the dollar and Fed picture today adds another dimension that makes both the bullish case and the bear case for silver constructive. The Federal Reserve is currently holding its policy rate at 3.50 to 3.75%. The dollar index is trading at or just below 98, down from its earlier 2026 highs, posting 3 consecutive weekly declines, with today's ceasefire news in the Strait of Hormuz pushing oil below $100 a barrel for the first time since the US-Iran conflict began in late February. Markets are now pricing a 50-50 probability of a rate cut by year-end, up dramatically from the 30% probability priced just 48 hours ago. Federal Reserve Bank of New York President John Williams stated publicly this week that heightened uncertainty should limit forward guidance on the policy path, though his baseline outlook still includes rate cuts over the longer term. Here is the critical binary that most retail investors miss. If inflation fears persist and the Fed holds rates higher for longer, silver's industrial demand remains inelastic. Factories continue buying at any price, and monetary demand for the metal as an inflation hedge increases simultaneously. If peace talks succeed, oil falls further, the Fed pivots to cutting, and the dollar weakens into the mid to low 90s as most institutional forecasters project, then real yields fall and non-yielding assets like silver become dramatically more attractive to capital that was earning a real return on cash and suddenly isn't. Either path, hawkish Fed with persistent inflation or dovish Fed with a weakening dollar, is constructive for silver. That is not a coincidence either. That is what happens when an asset has structural supply constraints colliding with inelastic industrial demand at the same moment that monetary conditions are shifting in its favor, regardless of direction. Now let's talk about what the research desks with compliance departments and reputational accountability are publishing as their price targets. Bank of America's Michael Widmer has published a silver price target range of $135 to $309 per ounce based on gold-silver ratio compression scenarios. Citigroup has set a target range of $150 to $170 for silver. The Reuters poll of analysts currently projects a 2026 average silver price of $79.50 per ounce, and that number was $50 as recently as October 2025, meaning that analyst consensus has been continuously chasing a market they have consistently underestimated. JP Morgan's average silver price forecast for 2026 sits at approximately $81 per ounce, but JP Morgan's gold forecast, which has the most direct mechanical relationship to silver through the gold-silver ratio, now projects gold reaching $6,300 per ounce by year-end 2026, and has outlined scenarios in which gold hits $8,000 to $8,500 per ounce in coming years if private investors move their allocation from 3% to just 4.6% of total assets. Goldman Sachs has reset its gold forecast to $5,400 per ounce by December 2026. Morgan Stanley carries a bull case target of $5,700 for gold in the second half of this year. Societe Generale has a $6,000 gold target by year-end 2026. Wells Fargo revised to $6,100 to $6,300 in late March. The gold-silver ratio today sits near 59. If institutional gold targets are even partially realized at the $5,400 to $6,300 level, and the gold-silver ratio compresses to the 40 to 50 range that has been the historical norm during periods of structural silver demand, a compression Bank of America explicitly models in their 135 to 309 target range. The arithmetic of where silver goes is not fringe. It is the output of conventional financial modeling by banks with reputational accountability for what they publish. These are not fringe projections. These are major institutional research desks with compliance departments publishing these as base case and bull case scenarios. Now let's run the three scenarios as they stand today. The base case, built on data already documented, silver consolidates above the $70 structural support established by three separate tests between March 19th and March 30th, grinds higher as the May COMEX delivery pressure forces price discovery, and reaches the $90 to $94 resistance zone, the early March highs, within the next 60 to 90 days. In this scenario, no new catalyst is required beyond the physical delivery dynamics already in motion at COMEX, the ongoing Chinese export licensing suppression of arbitrage flows, and the continuation of the sixth consecutive annual silver deficit now projected by the Silver Institute at 46.3 million ounces for 2026 alone. The bull case, which requires no heroic assumptions, simply requires acceleration of what is already underway. If the May 2026 COMEX delivery window produces a delivery demand that materially strains the 124 million ounces of registered inventory, and at a paper leverage ratio of 7.5 times, it does not require all contract holders to stand for delivery. It requires a number closer to 13%. You get a price discovery event of the kind that the COMEX has not managed since January 2026, when 33.45 million ounces of silver were withdrawn in a single week, representing 26% of registered inventory in 7 days. If that scenario repeats even at half scale in May, the path to $100 and above is the path of least resistance, not a speculative projection. In this environment, Bank of America's $135 to $170 range for 2026 moves from bull case to base case. The bear case rests primarily on a rapid geopolitical de-escalation that brings oil prices sharply lower, normalizes inflation expectations, eliminates the safe haven monetary bid from precious metals, and somehow reverses 3 years of COMEX inventory drain simultaneously. Here is what the bear case does not reverse: the 6-year structural deficit in global silver supply, the depletion of 760 million ounces of above-ground stock since 2021, China's licensing framework, which is a government policy designed to last through 2027 and mirrors a rare earth strategy that Beijing has maintained and tightened over a decade, The IEA's demand projections for solar and EVs, which are function of installed capacity already built and contracted, not sentiment. None of those factors change because the Strait of Hormuz reopens. They change when China abandons its strategic resource nationalism posture and alternative refining capacity is built in the West, measured in years, not quarters, and requiring 2 to 3 year minimum timelines, even with committed capital and regulatory clearance. These risks are real. A de-escalation premium unwind in the safe haven bid, renewed dollar strength from Fed hawkishness, or a technical rejection at the $90 to $94 resistance zone. These are not dismissible outcomes. The bear case is honest, and you should hold it in mind. But here is what it cannot change: the structural floor. Now, what does this mean for you specifically, based on where you sit today? If you are already holding physical silver, this data validates your position at a level that the Western paper price mechanism has not yet acknowledged. The 55% delivered cost premium in Shanghai is not a number that exists because Chinese buyers are irrational. It exists because they have access to the same supply chain data you just heard, and they have made the calculation that paying 55% above Western spot is rational given what they know about where this market is going. A 5 to 10% pullback from current levels, if it happens, is noise in a market where bank research desks are publishing base case targets at $79 to $135, and bull cases extending to $309. The architecture of your position has not changed. If you are considering entry, here is the one specific factor that today changes your calculation. The May COMEX first notice day is 8 business days away. The arbitrage mechanism that historically compressed the Shanghai premium, Western silver flowing east to meet the bid, is currently throttled by Beijing's licensing framework. That means the Western paper price is running below the real physical clearing price by a margin that the market will eventually be forced to reconcile. Positioning before that reconciliation completes is the opportunity this price represents. You are not buying at $80 because silver went up. You are buying at $80 because $80 is still the COMEX paper price, not the delivered physical price, and those two numbers are in the process of converging. If you are evaluating mining equities alongside physical, the disconnect between silver's price performance, up nearly 30% from March lows, and mining stock valuations that have lagged the metal's move suggests the leverage trade many investors look for in the mining sector has not yet been priced in. The operating leverage a miner carries at $80 silver versus $50 silver is substantial, and in several cases the balance sheets have not yet been repriced to reflect the new reality. Do your own research, understand the specific balance sheets and all-in sustaining costs, but the disconnect is documented and worth your attention. Let me bring this together, because none of these signals are operating in isolation. COMEX registered silver down 80% from its 2021 peak. Paper leverage at 7.5 times with first notice day 8 business days away. Shanghai premium running 55% on a delivered cost basis because China's licensing framework has severed the arbitrage flow that previously rebalanced these gaps. 6 consecutive years of structural global supply deficits with the 2026 shortfall projected at 46.3 million ounces, more than 760 million ounces of above-ground stock consumed since 2021. The IEA projecting solar and EV demand to consume half of all global silver output by 2030. The Sprott Physical Silver Trust doubling its capital raise to $2 billion in January. JP Morgan shipping metal eastward at $10 premiums above COMEX. 15 consecutive months of record physical deliveries at COMEX culminating in a 65 million ounce single-month record in December 2025. Goldman Sachs at $5,400 gold, JP Morgan at $6,300. Citigroup targeting $150 to $170 silver. Bank of America modeling $135 to $309. The dollar posting 3 consecutive weeks of declines, now below 98, with rate cut expectations moving from 30 to 50% probability in 48 hours. None of these things occurred simultaneously in 1980, none in 2011, none in the previous cycle. They are all happening today. While mainstream media watches ceasefire negotiations and oil price charts, the real story is a physical silver market in Shanghai paying 55% above the Western number because the supply that should rebalance that gap is sitting in a Beijing licensing queue. $80 is not the reflection of a fully priced market. It is the number the paper market produced before the May delivery window opens and before the full structural weight of China's export framework is priced into Western contracts. John here. If this connected dots that weren't connected for you before, hit like, subscribe, and drop a comment. What is your price target for silver by end of 2026? 100, 135, higher? Let me hear from you. Stack with conviction, hold with patience, understand what you own.